Okay, let me log in as a student. I go to courses, I go to business, and I'll go to corporate. This is for the simulation. We won't be using it today, but we will start very soon. And just for the assignment, by the way, I gave you a list of about 100 companies. If you do want to, let me just accept those guys. If you do want to use a different company that it's not in the list, I strongly recommend to go to the simulation and check. You can put all companies and just make sure that the name of the company is here. And then after you find it, let's say, I'm just making it up, let's say you decided you want to do it on this company, I have no problem. All those companies are traded in the stock exchange in the US. So you can use any one of those, that's fine, okay? Just to make your life easy, make sure you can choose 2019, make sure you go to data. Say, for example, this company I wouldn't recommend. It's missing a lot of the data. So that will make your life hard to go and find your annual report and fill up here the data. By the way, you can fill it up right here. For example, if I'm just typing, it will keep it for you in the server. So, and it will do the whole calculation when you're done. But I strongly recommend don't choose a company like that. You will have enough work to do without it. So, and that's one of the reasons I added that simulation. There's a lot of very good companies like, you know, Amazon is an excellent company. Netflix is a good one, probably Facebook. There's a lot of them in the list, but if any company you choose, make sure you have all the data, or at least most of the data, so you don't have to work hard, okay? That's one comment that I heard from people, if they can use different companies, so the answer is yes. Let's go back to our course. And I'm going back to the material. Please notice that in every section, I take a test. The purpose of it is I'm accumulating questions that will assist you basically to prepare for the exam. Many of them are, if you read the chapter, which I ask you in the book, chapter 1 in the book, it's excellent chapter. It really is an excellent chapter. It's excellent book, I should say. We definitely, unfortunately, we won't be able to cover all of it, but definitely, first chapter is good. Then I will ask you to read the next chapter, not immediately, but I will follow up and I will tell you which chapters to read and which one not. But in every chapter, it has questions in the end. You can see in every chapter at the end, you have questions. And the way I did, so you can have discussion about them and encourage some active participation. I put, I think, about 5 or 6 of them. And if you notice here, if you go on the top, you have a syllabus, but you have also a blog. If you go to the blog, I posted those questions in here. Most of them, you can go next, and there's more of them. For example, long-term perspective on value creation. If you click on it, what benefit does the long-term? This is exactly a questions I took from the book. And that will be really nice if you guys go in and just add your comment, like you see here, one comment somebody already put in, okay? But this is really what's from today, okay? You can add your own comment, and people can comment on your comment, and that's really will help you also. I might even put those questions in the exam finally, and then you'll have a really good practice for that. That's one thing. The second thing is, let me go back. Here we go, sorry. The next thing that, as I mentioned, I had take a test. This is really summarizing a lot of things that we studied, some from the book, from the text itself, and you can get a response right away. What do I mean by that? If you click on first question, if you say this is the right answer, and it is the right answer, it will tell you it's correct, and it will tell you already what your grade. You answered 1 of 1, which was correct, so it's 100 because it's 1 of 1 was correct, and you got already 5 points because there is about 20 or 22 questions. You go to the next questions, okay? You click on it, it also was right. Let me choose something that I'm answering wrong. I answer wrong, okay? So it's giving me that I'm only 67% of the question I already answered. You get also a response right down here, so you can keep trying until you get to the right answer. So I think it's a good way of studying, and here is all the answer correct, so you should really read the other ones as well, okay? Hopefully it will help you for studying along the semester and not only when you get to the exam. Most likely I will take a few questions from those definitely to the exam. If you have any suggestions to do it better, you're more than welcome. Please do. Okay, my ears are always open. I always love to do it even better. I added the homework here. Usually assignment is a group assignment. Homework is for individual. Basically, the only things I'm saying here, please read chapter 1 and go to the blog and participate, okay? I'm not gonna, it's really for you, so you don't really get a lot of things toward the end of the semester. Okay, let's review shortly what we did last time. We talked about which kind of valuations there are out there. So we mentioned 3 common ones: intrinsic valuation, relative valuation. I kind of gave a little motivation why people deal with what is called real options pricing. Over the semester, I might touch on it. I just review some. It's not the main part of this course. It's mostly for, I should say, really a master degree level. Then we'll talk about simulation. I will demonstrate it when we get to the simulation itself, and I'll show how do you use a simulator inside the simulation. I just mentioned it last time what it does. Then we started a little bit, I gave a little background, and then we talk about what can go wrong in evaluation, how important it is to know a lot more than just number in a company, and chapter 1 in the book really covered it very nicely and completing my lecture. We mentioned relative valuation and we compared it to the intrinsic valuation. I talked a little bit about the differences, and I put the lectures down here. The recording for today's session I'll put right under it. There's 2 classes that I'm giving. One starts 11:30 and one now, and I'll put both recording down here. So you always will have the recording just in case you couldn't make it for some reason, okay? But I really strongly recommend you'll be here. You listen to the lecture, you can ask questions, and okay. Now, let's see what we're going to do today. We started a little bit last time, and usually this lecture not supposed to be really part of this course, but from my experience, it's a must session. And that's really talking about accounting, and later on I will talk also on finance as we go into estimating cost of capital, and we get to the simulation, I will talk about some statistics a little bit. Okay, but accounting is almost a must. Unfortunately, it's something we have to know. And my recommendation, just do it the right way and then move on. So that's what we're going to dedicate most of the session today. And after that, we can just focus on the finance and corporate valuations. So let's start. We talked about, and you already have studied an accounting course, that there are three statements: balance sheets, we have income statement, and we have statement of cash flow. In the US, there is another statement. It's a statement on change of equity. In fact, in the US, it's really a schedule. In Israel, they call it a statement. Okay, so let's start. We have a balance sheet. I'll go over it in a second. Income statement and statement of cash flow. Statement of changes in equity is less crucial because we will derive it from the statement of cash flow. Okay, any questions so far? I will try to pause and give you a chance to talk because teaching through the Zoom is a little different, and I would like to hear if there's any questions. Go ahead, guys. Can I move on, or there are any questions? I assume I can move on, yes? Anybody? Just give me a live signal.
Yeah.
Okay, good, thank you. Okay, let's look at the balance sheet. The balance sheets, we have assets, we have liabilities, and we have equity. And this is, the balance sheet is usually based on book value according to accounting rules. The same things we can talk about market value. We can have market value of total assets, market value of liabilities, and the equity market value should be market value of total assets minus market value of liabilities should give me a market value of equity. That's what we really care about in this course. But we have, unfortunately, to deal with, the only things we have in our hand is book values, okay? So we're going to translate those numbers and understand them in such a way we can conclude about what the market value should be. So here we have current assets. If you notice, I didn't really break it down to cash and other current assets, which cash means is really inside the current assets. And then we have these ones is the long-term assets, property, plant and equipment, subsidiaries, intangibles. All those are long-term investments. Then we have liabilities. They have two parts, and one is current liability and one long-term liabilities. By the way, in the questions that I posted, you should see from the answer I put there, sometimes current liabilities will include the current portion of a long-term liabilities. What do I mean by that? Let me give an example. Let's say, for example, here we have a long-term liability, 600,000. But it might be that some of the liability are due in next year. That part that I'm supposed to pay within the next year should be as part of the current liabilities. Does that make sense, guys?
Yes.
Yes.
Good. Okay. We will see in future session why is it important. I just wanted to make a comment on that. Okay. We usually, as I will discuss it more later on. I'll just throw it now without talking about it. We will have to put it back to the long term when we do valuation. For now, let's ignore it. Just remember you heard it. Equity.
Amos,
Yeah, go ahead.
could you maybe explain why accumulated depreciation is an asset?
No, it's in a minus if you see. I have that's the amount the company have paid, and that's the accumulated depreciation. That means it seems like if you look at the next year, it's 80. That means the company probably purchased that assets for 400,000 beginning of 2010. They depreciated 40,000 this year. They depreciated another 40,000 2011. Accumulated depreciation was 80. So if I want to look at net assets, it will be 400 minus 80. So 2011, I have 320 net assets. 2010, I have 360. Does that make sense?
Does.
Pay attention, it's a negative and it's accumulated depreciation. It's not depreciation of the year, but accumulating over all the years since I bought that asset. Good. And I will come back to that depreciation issue later on. Beautiful. Let's look at the equity. In the equity, we have common stock. Common stock means, let me see if somebody joined us. No, good. Okay. Common stock, it's how much did I raise by issuing equity? According to this report, I issued $50,000 worth of equity based on book value, and I haven't issued any common stock in 2011 because the same number, it's the same number in both years. On the other hand, retained earnings have changed. To understand what the meaning of the change, we should first understand the meaning of retained earning. By the way, I need to change here. I always forget. I asked someone from the previous session to send me an email. I will fix it today, okay? I apologize. It should be retained with AI and not you. I mentioned that last time and I forgot about fixing it. So if somebody even throw me an email, I will appreciate it so I won't forget it. Okay. Okay, what is retained earning? We define it as follows. It is total net income over the years that the company have made since it was established up to the current year. Current year for the 128 means 2010. From that net income, I subtract all the dividend the company have distributed since it was established. Same things apply for 2011. 170 means the total net income the company have had since it was established minus all the dividend the company have distributed up to the end of 2011. So far, so good, guys? The definition is clear?
Yes.
Good. So let me ask you, how would you define the difference between 128,000 for 2010 and 170,000 the end of 2011? Any
Money,
volunteer?
money reinvested in the company.
Dividends.
Dividend, almost.
Money reinvested in the
That's
company.
correct. It's money reinvested in the company. It's absolutely correct. But go in line with the way I define the retained earning. And what does it really means now? The difference in retained earning. I use the word net income, I use the word dividend, remember?
That's net income.
Beautiful. So if I want to know what is the difference in retained earning, it will be net income. And then what else you need to do in order to get to that difference? Subtract the
dividends.
the dividend of that year. Absolutely. See, this is the 128 is net income accumulated up to 2010 minus all the dividend up to 2010. Some things is for 2011. All the net income minus all the dividends. So the difference must be the net income is the extra minus the dividend of that year. So if I will look at Excel, I made here an Excel last session I was teaching. Let me just accept those guys. Sorry about it. And if you look at this Excel, okay, we have in the beginning of the year, we have 128 as retained earning by the end of 2010. Net income, if we see here, it's 100 to 50. So I'm going back to my Excel, and the net income for the year, it's 100, 250. I need to add to this one, the 101, 250, and I need to subtract some number to get to 170. So if I do the calculation, the number must be 59 to 50. Does that make sense?
Yes.
Okay, so by knowing the difference in the retained earning, knowing the net income here, I can find the 59. Fair enough? Somebody have mentioned that the difference in the retained earning, it's what the company is using to invest in the company, and I said that's correct. And if we look at it, the company have made 101 as profit, out of which they have distributed 59,000 to 150. So the difference, 101 minus the 59, should be the amount the company have kept to invest in the company. In another word, the difference in retained earning, which is net income minus dividend, that's really what the company is reinvesting in the company. Let's do a recap, okay? We have retained earning beginning of the year. We have retained earning in the end of the year. That's given. That number and that number. Then we are giving from the income statement that the net income is 101. Therefore, to the retained earning, I am adding the net income, subtracting the dividend, and I'm getting to the retained earning in the end of 2011. The difference between net income and the amount I distributed as dividend, it's the difference between the retained earnings. In fact, the difference between 128 and 170, it's exactly that difference. And that difference, it's exactly what the company is reinvesting in the company. Any questions? Is that clear? Give me a sign, guys.
Yeah, it's clear.
Anyone is not clear, I will repeat it. It's very important, extremely important. I always love to go slowly in the beginning, go step by step. When everything is fit, then we can go faster. If now we go too fast, when it's not clear, we'll get stuck later on.
Just a question.
Sure, go ahead.
So the kind of the equation is retained earning beginning plus the net income of the beginning period minus the dividend equal the retained earning of the ending period.
Correct.
Right?
Correct.
Okay. Just to be sure.
Yeah.
Thank you.
Excellent. Okay, good. So let's move on now. So now that we understand that difference, let's move on. Net income, let's look at that a little bit. We have revenue, cost of goods. So by the way, it's very classical. You have a lot of items that are not in this type of income statement. We're not going to dive into them. That's for more advanced course. We have revenue minus cost of goods sold. The meaning of cost of goods sold, it's how much it costs me to generate that revenue. So if I'm selling some product, that will be the cost of the product I sold. That's the revenue from selling it. That's how much it cost me. I might have manufactured it. I might have bought it, whatever. Then we're getting the gross profit. So everybody, by the way, this is already strongly recommend you learn by heart. It's so basic and it's repeating itself. I strongly recommend to study it by heart. You'll face it in real life. You face it in graduate school if you go, which I hope you do. And then, okay, so gross profit. From gross profit, we subtract selling and expense. Many times you will see selling and marketing expenses. Okay, and then you'll have general administrative expenses. That brings us to operating income, also known as EBIT. EBIT means earning before interest and taxes. Okay, I will repeat. Earning before interest and taxes. Very important number in valuation. From that amount, we subtract interest expenses. okay? And then we get income before taxes. From that, we subtract taxes, and we get it to the net income. Well, if you follow the lines from this point to this point, you can think about the EBIT as how much money this company really created, or what is the profit this company have created, and who are the partners. And you can tell that there are three partners. The first partner is the people that gave loans to the company. They're getting compensated by getting interest expense. So far, so good. Then the second partner, it's the government. Whatever left, they're taking their share out of it as taxes. And whatever left, it's for the third partner, who is the shareholders. So this part goes to the debt holders, this part goes to the government, and this part goes to the shareholders. Okay, that's what we're getting from the income statement. Let's move to the most interesting one. I know that you usually don't spend enough time, in my opinion, in accounting course to study it. So let's go over it. It's very important. I'm going to spend some time on it and really understand it. And I will start with a really odd question. You know, when we looked at the balance sheet, we have total assets. That's a meaningful number for us. Here, this company is around 800. That tells me how big is this company. Okay, the bigger the number, that means they have more assets, it's bigger company. Liability relative to the total assets can tell me how much they are leveraged. You might have heard that concept in finance. Okay, so that tells me how much I owe other people. Okay, and whatever the difference, it's just telling me how much it belongs to the equity people. So all those numbers are meaningful, and it tells me something about the company when I do valuation, and we'll see it's more as we go along. Some things about income statement. You know, I have a big revenue, and if the revenue is growing, that might be a good sign, as we will see. Some things about gross profit, and definitely about net income. I see here the net income went down. That might have a negative signal, okay? But every number, and especially the bottom line, it's very important. This is what goes to the shareholders. It's very hard to say the same about statement of cash flow. By the way, I intentionally chose the example that in the bottom it will be zero. What does it mean having a zero in the bottom line of a statement of cash flow? I will repeat the question. Anybody can help and say what the meaning that in the bottom, the statement of cash flow, I am getting zero. Anybody? Please do.
The company spends as much as it earns.
I'm not sure. You're getting close.
There is no change in the cash of the company, meaning maybe they have like I don't know, kind of an inventory of cash, and there is no change. It's the same as last year.
Beautiful. And that inventory is really, it's their bank account, isn't it? You know, the money they have in the bank account, usually, company usually work with a bank, they have account, and when they're paying supplier, they're paying from that bank account. When they're getting money from customers, it goes to the bank account. So having zero there, it means the money in the bank account didn't change. Is that a good sign? Is that a bad sign? Well, maybe the company already have enough cash and they don't really need to increase it. They're rather maybe to increase their inventory, maybe to buy more assets, but no reason. They're doing just fine. They have enough cash to pay their debt. They have enough liquidity. So what's the reason to increase it or decrease it unless there is a major change? A major change, or if a company is growing, let's say every year 10%, definitely after a few years, when a company is very big, I would expect that they will have more cash to handle daily operation. So you will see maybe some increase here that goes in line with the increase in the size of the company. But if I see a small number, it shouldn't really bother me that much. Moreover, if that number was signaling something about the company, in another word, if the company is increasing the cash, has a meaningful things about the value of the company, managers can take a loan in the last day of the year. You know, when you take a loan, your debt will go up. At the same time, your cash in the bank will go high. And everybody will do it if that will affect the value of the company. So taking a loan in the end of the year, I hardly can see a reason why it should increase the value of a company. Because when you're increasing the cash in the bank account, and at the same time, you have more debt, nothing really changed in the company. It might even hurt sometimes if you have to pay interest on money you don't need. Does that make sense, guys? Anyone?
Yeah, it does.
Good, very good. So we shouldn't really bother with the last line, and we really should really focus on what the meaning of each section here. And that's very important, okay? Okay, let's look first what we call cash from operation. Let me really enumerate the three of them. All the three are extremely important for valuation, okay? One is cash from operating activities. The second one is cash from investing activities. And the last one is cash flow for financing activities. By the way, let me even start with saying usually, not always the case, but most of the time, the first one, it's a source of cash. The third one, usually it's a source of cash, not always. And the second one, usually a company that's growing, it's like usage of cash. You know, when a company wants to grow, they need to use cash to buy more assets, more building, more equipment. So as the company is growing, I would expect this number to be negative. So a negative number here, that means the company is buying more long-term assets. So seeing a negative number in the middle one, it might be a good one. That means the company is growing. Now, let's see what the difference between the first part and the third part.
Cash
Say
from
again?
investing. Cash from investing. It means reinvesting in the company or
Correct.
investing in general.
Correct. Cash flow from investing activities. The title is a little misleading because it's like a cash flow you're getting from investing activities. Should say the other way around. It's if I'm investing in the company, you know, I'm using cash. Okay, so the title is a little misleading. You're absolutely right. If I say here, cash flow from investing activities minus 20 means I used money to invest. Does that make sense?
Yeah, thanks.
Yeah. So we have here in this example 20,000 of that I used for investing in a long-term asset. In a minute, I will show how I got those numbers from the balance sheet. The first part, we started from net income, but as you know already from your accounting course, you always subtract from to get to the net income, okay? In the middle here, you subtract depreciation. Usually depreciation is embedded inside cost of goods sold. So if you see this number, most likely inside it, embedded those 40,000. But depreciation, as you know, it's an accounting calculation. It's not really any cash left the company. So in order to know how much I sold and how much profit I made on a cash basis, I should add it back. And that's why we always add the depreciation to the net income. So the sum of those two numbers together, it's like my net income on a cash basis, okay? Because depreciation is just accounting cost. It's not really that I spent 40,000, okay? So then we have the last one says change in net working capital. Let me just re-emphasize, I really should have said, this is the common way of writing it, but the way it really should say minus increase in net working capital. I'm re-emphasizing minus increase in net working capital. That means if a working capital goes up, you should subtract the increase. And why is it true? We need to know what working capital is. Anybody wants to help? What is working capital?
Inventory, maybe?
No, close. It's include the inventory, yeah. But
Money
what it is, the
you-
correct definition?
money you'd need to operate the company.
So let me help you out. That's why I put a question here. Let me go back. That's the objective of putting all those questions too. It's excellent for your review. If you go to take a test, I put a question just on that one. And if you scroll down, one of the question should be, what is, anybody sees that? Yeah, what is working capital? And I wrote accounting definition, and I just follow that with a question with finance definition. So that was the accounting, because we're dealing with accounting now. And here we have some choices. Is it the short-term asset minus short-term liabilities? Anybody vote for that one? Let's see if it's true. That's the correct answer. Pretty cool. Short-term assets minus short-term liabilities. Okay? Fair enough? So let's go back now. So working capital, it's the short-term assets minus short-term liabilities. And here it tells me you should subtract the increase in working capital. What does that mean? So I made here a little Excel, and I went to the balance sheet. Here's the balance sheet. And in the balance sheet, I said, let's calculate the current assets and current liabilities in 2010. So current asset in 2010 was 30,000. Here it is. Current liability is 32,000. So 30,000 minus 32,000, working capital as of 2010 was minus 2,000. So far, so good. That's the definition of working capital. Everybody agree? Questions before I continue?
No questions.
Good. What about 2011? I take the 40,000. I take the 30,000. The difference is 10,000. So working capital as of 2010 minus 2,000. As of 2011, it's 10,000. So increase in working capital should be 10,000 minus 2,000. That should give me 12,000. So increase in working capital or change in working capital was 12,000 increase. And what it really means, let's think about it for a second. What do we really have? You know, the working capital is made of this difference. So the 12,000, I can see it in another way as I'm spending 10,000 to increase the assets, and I'm spending another 2,000 to decrease the liability. That's why I had to use 12,000. One more time. I can see it also in another way. You know, 10,000 minus 2,000, it's also as I'm doing this one minus this one. That 10,000, it's money I must use for my bank account to buy more current assets. And this decline in 2,000, I have to use money for my bank account to pay current liabilities. So they add up to 12,000. Two ways you can look at it: the cold definition and the meaningful definition. Or one more way, you can think about it. What is really the meaning of the 10,000 here? The 10,000, it's the net assets that I have in 2011. Net in the sense, how much current assets I have over over current liabilities. How much assets I had 2010. In fact, in 2010, not only that I didn't have an asset, I had a liability of 2,000. Okay? So the difference between those two is the change in how much net current assets I have, which we call working capital. So the difference is 12,000. Okay? That money has to come from somewhere, because otherwise I won't be able to increase the current asset and I won't be able to decrease the liability. And therefore, that's why we subtract it in here. So let's wrap up. Cash flow from operation is the net income. We're fixing it up from accounting point of view that depreciation is not really a cash transaction, and therefore we're adding it up, and then we subtract the amount we use to increase our working capital, meaning net current assets. Net in the sense, current assets minus current liabilities. Now, don't be intimidated. It's really annoying, frankly. That's why nobody likes accounting. But it makes sense when you repeat it several times. I strongly really recommend do that, at least for do it several times so you feel comfortable. And when you get to graduate school or you get to more advanced and we will use it in this course, it will come natural to you. Spend the time now. That's why I added also questions in the questionnaire. Okay, now net cash from operation, 129,250. This is available to use for what? We can increase our assets in the company. Is that right? Correct? Anybody?
Again?
I'm saying I have in my disposal 129,250. That cash is in my bank account. I made a profit. In fact, depreciation didn't take any cash, so I really have that amount of cash. I use some of it to increase my net cash current assets, and now I have in my hand 129,250. That's a source of cash that the company can use. Does that make sense now so far?
Yep.
Good. Now, according to this chart, it means I'm using, out of the 129, I'm using 20,000 to increase capital expenditure. So let's see, let's go back to the balance sheet. Anybody wants to help me out to which number should I look at? Anybody?
Can you repeat the question, please?
Yeah, I'm saying, okay, we kind of got to this number, 129,000. Now, according to this statement, it tells me you were using 20,000 to buy more long-term assets. Capital expenditure, that means money you spend to buy long-term assets. And you spend over this year 20,000. And I said, wow, how do I see it in the balance sheet? In another word, if I acquired long-term assets, I should see that increase in the balance sheet. Yeah. What is the long-term debt in 2010? So here we go, I added those numbers in the Excel.
It would
And
be
let's look at
property,
it.
plant, and equipment.
Exactly, beautiful. So let's look at it. Let's look at the first one. Let's start from all over. Okay, I will do equal. So we have 400 we spend minus 40,000 depreciation plus 300 investment in subsidiaries and plus 120 that we spend on intangibles. Total spending in 2010 was 780,000. 780,000, that's the sum of all this minus this plus those two numbers. Okay? In fact, you could have taken 810 minus 30,000 would give you the same number. Okay? But this number is the total assets, long-term assets. Let's do the same things for 2011. Okay? So we have 400 plus minus 80 plus 330, okay, plus 110. Total 760. According to what I have here, I have a decline, not an increase, I have a decline of 20,000. Because I had in the beginning of the year net assets 780. The end of the year I had only 760. Therefore, the difference is decline of 20,000. Hey, wait, hold a second. This is totally the inverse of what I got here. Here it tells me, since it's a negative number here, that means I used 20,000 to increase the assets. On the other hand, according to my Excel, it's totally the other way around. The assets went down. It means I sold some assets. Does that make sense?
Yes.
I sold 20,000. But according to the statement of cash flow, it's exactly the opposite. It's showing me like I increased the long-term assets. That's why I used 20,000. Anyone wants to help? Anyone? How will you explain the difference? I give you a hint. There is a 40,000 somewhere here on this screen. Anybody spot the 40,000 here?
Depreciation expense.
Exactly. If you take the depreciation, you turn minus 20 to positive 20. Is that right? That's really the difference. Here it tells me that I spent 20,000. Here it tells me that I made 20,000, by selling. But it's a little deceiving. Why is it a little deceiving? Because when we look at the 780 and we look at the 760, we used the net long-term assets. Net, it means 400 minus the 40 and 400 minus 80. Is that right? Okay. That means if I really went down only by 20, I have to come up with this difference of the 40. Otherwise, the net will not go by 20, only it will go down by 60. So to make it up, I have to add back. I had to add back the 20, and that turns the minus 20 to positive 20. Let me make myself clear, because I don't think I was clear enough. I got here minus 20, but the decline by 20, okay, I had to spend 40 to make the net going down only by 20. So in order to fix it, I must add the depreciation. So this 20 it's after I added the depreciation. Let me sum it up and give you a rule so you will never get confused. I know it's not that clear right now, but in a minute it will be clearer. If I want to find the capital expenditure, I have to say by how much the net have been changed. The net in total assets, if let's just look, it was 780 versus 760. The net went down by 20. I always have to add the depreciation because otherwise the total assets would go down by 60 and not only by 20. Let me give another example, which I like, and it will make a lot of sense to you. Let's say I had 100 machines at the beginning of the, let's forget about this example for a second, and I'm making up another example, okay? Let's even open the Excel and do it on the Excel. Let's say beginning of the year, I had 100 machines. The end of the year, I find out I have 105 machines. I'm counting them. Is that fair enough? So what is my net? What is my net investment? My net investment will be 105 minus 100. Is that right?
Yes.
Correct? Yeah. So how much cash did I spend? Did I spend only 5? Well, according to what this screen shows, yeah. But how about if I told you over the year, and that's what depreciation is, I have lost 10 machines. That's the depreciation.
But is there a difference between depreciation and losing 10 machines? Or are you implying that they have the same meaning?
Yeah, bear with me a second. I'm going to go over it. So I'm saying, okay, this is the fact. This is how many machines in the beginning of the year. Fair enough? This is, let's make it a little bigger. This is machines end of year. Okay? And now my question is, what is the capital expenditure? That's what I want to know. Is it really 5? Then you say, no, Emo, it doesn't make sense. You had 100 in the beginning, you lost 10. That means if you didn't make any investment, you should have had in the end of the year only 90. Does that make sense?
Yes.
Yeah.
Therefore, if you really arrive to 105, that means you invested 15 because you couldn't get from 90 to 105. Does that make sense now?
Yes.
Yeah.
Okay, good. So if I'm taking 105 minus 100, that's not good enough. I must account for the depreciation as well. So I must add to this one 10, and then I will add up with 5 plus 10 will give me 15. So far, so good?
Yeah.
That's really the case. Okay, this is very important. So what are we doing here? What we did in the previous example, which just because the signs are the other way around, it's a little more confusing, but really don't let it confuse you. We went down by 20, okay? But we really had to add the fact that we went down only by 20. That means we had to invest also, see from the 780, we most likely went down by 40, the depreciation, okay? Okay, we went down by 40. That means we got down to how much? We got to 740. So it really means that we really have spent 20,000. And that's really what makes sense. And that's really what
the LTA on line 20, That's long-term
Calculate means
asset?
long-term assets, sorry.
Okay,
Yeah, that's long-term assets.
thanks.
So, rule of thumb, now that you understand it, okay, you always do. You take total long-term assets, the net total long-term asset, tax the difference, you're getting that difference. Add back to it the depreciation you've done. That's how much you spend on long-term assets. One more time. I take total net investment in long-term assets for the previous year. I do the same things for this year. Pay attention, this is a negative because it's accumulated depreciation. I get two numbers. I take the difference, I get a number. That could deceive. This is not the right number. I must add also the depreciation. When I add the depreciation, I do get the right number of capital expenditure. Fair enough, guys? Make sense?
Yeah, it does.
But capital expenditure is negative, right?
That means I spent 20,000. If I spend, you're absolutely right.
So actually, it can correct itself
20,000 will
alone.
be negative here. You're right. You're absolutely right.
So actually, if I do the same calculation and I plug it here, it will be right? Straightforward?
Correct.
So I don't have to do like the whole thing of adding, right? The depreciation.
No, in fact, the only things you do, you take the total long-term asset. Usually it's really presented as a one line. I don't have it here in this balance sheet. But usually you'll have current assets by itself, and then you have long-term assets, and you have all those stuff under it. So you get a number. You get a number for this year. You take the difference. And as I did here, I took the difference. But I said, this will be wrong to conclude, okay, that I sold 20,000 because I had to rebuild the depreciation as well. So I did have to spend 40,000. Okay, so if I spent 40,000 and I went down by 20,000, that means net of 20,000 out of my pocket. Got it?
Yes.
Yeah.
Good. Okay, so now you can forget about this discussion. Now that you understand it, you say, anytime I have to deal with long-term asset capital expenditure, take the difference, and add to it the depreciation, I'm done. That's the way you get to this number. If it's increased, okay, you know, it went down by 20, but we added the depreciation 40, we got positive 20. That means we spent 20,000 out of pocket to bring the assets to go down only by 20,000. Good. Now let's move to, okay, so we're done with that one. From 129, we're going to use 20,000. That's what we used in order to increase, you know, in order to make up for the depreciation and to make up for the depreciation, we went down only by 20. Okay, we spent 20,000. So it's giving me 100. If I take those two numbers together, it's 109 to 150. What did we do with that money? So let's see. Let me ask you guys. Let's look at the balance sheet. What happened to the long-term debt? You know, in the beginning of the year, we had 600. What happened in the end of the year?
Decreases.
It's less. How come it's the liability, it's lower? How is that gonna happen?
You pay some of
Pay
it.
back.
You're right. I paid some of the debt. So that means that for the debt holders, I paid them 50,000. So I used part of the 129. I used part of this money, whatever left, 105. I used 50,000 to pay the debt. Fair enough?
Yes.
Everybody agree?
We see it again on the balance sheet.
Yeah, the difference, this 50,000, it's right in the balance sheet. It tells me you have paid 50,000 of the long-term debt because it used to be 600 in 2010 and now it's only 550. That means you paid, you paid the principal of the debt of 50,000. Does that make sense?
Yes.
What else did we pay? We paid also something here. Remember here? We paid dividend. Remember the dividend? Let's go back. How much dividend did we pay? Everybody remember the dividend, 59,000?
Yes.
Okay. So now from the income, you know, by the way, it was the 101. Remember from the 101, we paid the dividend. We had retained earning. We have net income, out of which we spend dividend, and that gave us the end of the year retained earning. Thereby, I can conclude now and say, what do I have in this third part? I paid some of the debt, and I paid dividend. Did I pay anything? Did I issue any equity? Did I repurchase equity? The answer is no. How do I know that? Because when I look at the balance sheet, common stock used to be 50 and instead 50, meaning I didn't issue any more stock and I didn't repurchase any stock. On the other hand, on the debt, I did repay part of the debt. Does that make sense so far?
Can I ask a question?
Sure.
If you had issued stocks, then would the equity number be positive or negative?
If there is an increase, if it's an increase in the debt, let's say from 50 it went to 150, that means you raised money for the company, correct?
Yes.
Then I should have seen here in this line, positive 100,000.
Okay.
Makes sense, is that right?
Yes.
Beautiful. Now I
Amos,
want to go and ask my favorite question I always ask. This is what the accountant like to prepare their statement of cash flow. By the way, under the IFRS, you are allowed to do some small corrections to this statement of cash flow. Let me just help you out and ask the question. If I look at these three lines, interest-bearing debt, that means long-term debt. If I'm repaying, it will be negative. Am I issuing more debt, meaning raising more money by taking loans, that will be positive. If I'm paying dividend, that will be negative because I'm using cash. If I'm issuing more equity, it will be positive. If I'm repurchasing my equity, it will be negative. I'm claiming something is missing here. Conceptually, I'm as a finance person now, not as an accountant, something bothers me because I see dividend goes with equity. Is that right? Correct? That dealing with the equity people. Is that right?
Right.
Okay, what about the debt?
Liabilities?
No, the liability is the debt, you're right. But see, here I'm accounting with the equity. When I'm issuing, it will be positive. If I'm buying the shares back from the people, it will be negative. Okay? When I'm giving dividend, it means I'm giving money to the shareholders. I'm accounting for it here. With the debt, when I'm buying back or I'm paying the debt, it's negative. If I'm issuing more debt, it will be positive. What else do I do with debt people? People that own my bonds.
I mean bonds?
Yeah, bonds or just taking a loan from the bank.
Because bonds, there is some coupon that you have to pay, but I don't think you mean that, right?
The interest, yeah. That's what I mean. On bonds, I'm paying the interest. Is that right?
Yeah.
If I take a loan from the bank, I'm paying interest. Isn't interest for debt is like dividend for equity? See, if we're looking at the income statement, we're getting to the EBIT, remember? Interest we're paying to the debt holders. And whatever left, it belongs to the shareholders, is that right? Out of which we're paying dividend. So in another word, if I want to see who are the investors in this company, the investors in this company, there's two investors. People that give me a long-term debt and the equity owners. Those two guys gave money to the company. The long-term debt and the common stock, they're giving money to the company. What do they get back in return? The long-term debt getting interest in return, and the stock owners getting dividend, and whatever left, it's retained earnings for them for the future, okay? So when I look at the statement of cash flow, and I want to ask how much money did the equity owners have received from the company, you immediately can tell me they have received 59,250. The sum of those two gives me how much the equity people have received. If I ask you how much money the debt owners received, you will tell me they got 50, but they also got interest, isn't it?
But this is the interest, you say.
No, this is it's the title of the debt. Usually I call it interest-bearing debt. It's a debt that you pay interest on it, but that's not the interest. This is the principal I paid. It's just the title of the debt. It's not just it doesn't include current debt. Current debt doesn't have interest on it, but long-term debt does have interest on it. So it's another word. This is another title to long-term debt. Interest-bearing debt, it's a different title to a long-term debt. So I paid them 50,000, but if you look at the balance in the income statement, how much more interest did we pay? This last year, 110, and how much did we pay this year?
130.
So how much money did the debt holders receive this year?
20.
They received 130 as interest. They received 50,000 because I reduced the debt, and the total will be 180. Does that make sense?
Yes.
Yes.
Good. So when I look at this statement, this is a little missing something. I must add to these three lines another line, which would say interest to debt holders. And that should be 130 in 2011. And together will be 180. How much money the equity people received is the sum of those two. So let's sum up everything together. Okay? In the statement of cash flow, right here, we only saw this part. Usually we are, as a finance people, how much the investors received. Investors means debt holders and equity holders. How much do they receive together? I will say, this is really what the equity owners received, plus how much principal I paid on the debt. That's what we have here. And we added the interest, 130, to here. Then I get that how much cash flow I paid the investors. Investors means debt holders and equity owners. It's 239,250. We are, as a finance people, this number, it's meaningful to us. We must add the interest and how much I paid the debt holders, how much dividend we paid, and if we repurchase the equity, it will be a plus. If we issued more, it will be, it will be negative. And if we reissued equity, it will be a plus. That's a very important number. Has
Can I ask
four
a question?
components.
Why is the dividend in minus and all the rest, like in the balance sheet, it shows both in minus, and in the cash flow for investors, it shows only the dividend in minus.
Beautiful. See, it depends on which direction I'm looking for. In the title here, it says cash flow to investors from the point of view of the investors. Okay? So the truth of the matter, I apologize. This should be plus here. You're right. You're absolutely right. This one should be plus, not a minus. Here it's okay minus. Okay?
Can you explain that again? Why is the minus okay there and
Yeah,
not okay
exactly.
there?
Okay, I will fix it. I just, by mistake, probably put a negative there. Let me explain. Let's look from the company point of view. The company have spent 130 as interest, so it's a negative for the company, correct?
Correct.
The company paid dividend, so it's a negative for the company, correct?
Correct.
The company have paid part of the loan, 50,000, so it's a negative for the company. Okay, so we have negative 50 for the company, negative 59, and negative 130. For the people that receive the money, all of those should be positive.
Correct.
So therefore, that's why I discovered that I made a mistake. By mistake, I put a negative here. I probably just copied that number here and then erase the negative. Okay, so that should be the debt holders received interest of 130. For them, it's money they received. They received money for me paying them back for the principal, and the equity owners have received dividend of 59. You will add it up, just ignore the minus. When you add it up, it's 239. Does that make sense? Why? Here it's negative because I'm looking from the point of view of the company. Here it's positive because I'm looking from the point of view of the people that received it. That's why it's positive here.
Can I ask you a question about how you determine the interest expense? Because I'm seeing here that 1 year they paid 330, then 2011 they went down, but their interest expense was higher. Isn't interest expense usually a percentage of EBIT?
Well, try to answer it. I love the question. Let me repeat it, okay? Tell me if I got your question right, and try to solve it yourself. Last year, by the end of 2010, we had 600,000 dead. The end of 2011, we had 550. And you're saying, how come I had much more death in this year and I'm paying only interest? What is the interest? I'm paying 110 in 2010 when I had more death. On 2011, I'm paying more even if I have less death. Love the question. Beautiful question. Try to answer it.
Because we know that as time goes on, you pay less of the interest and more of the principal.
Let's assume the interest rate stayed the same. Just to re-emphasize the point. But it's a beautiful question. Let's think about it. Let me make the example a little simpler so it will re-emphasize why I love the question. Let's say in 2011, I paid the 50,000 in the last day of the year. And in fact, in 2010, I had only 550 all the year, and the 50,000 I took the last day of the year. You got my point?
You're saying it's about the timing of the payment?
Exactly. So assuming in 2010, really all the year from the beginning of 2010 up to the last day, the debt was really 550. The last day, I took a loan of 50,000. So in the balance sheet, it should show me 600, although most of the year I had only 550. That makes sense so far? What happened in 2011? 2011, I really didn't pay the loan until the last day of the year. So in 2011, really most of the year, almost all the year, I had 600. And that's very tricky. It's a beautiful question. And so that makes you to be more suspicious and more inquiring into those financial statements. And this is the kind of question you really would like to look into and ask them, how come this is lower than this? And then you say, well, I will even, you know, I push your question even further. We will deal with WACC later on. And then one of the things we'll say, what is cost of debt? It's the interest rate. What should I do? Should I take 110 and divide by 600? I will get a number. Is that right? That's supposed to be the interest rate. I will take 130 divide by 550, and I say, this should be the interest. And definitely you're getting two different numbers. Which one is the right one? And we will have a whole discussion on that topic when we get to that. Okay, so the question is right in place. It's just telling you that the numbers you see in the balance sheet, it's the last day of the year. It doesn't mean this is the average debt they had all year long. And 550, it's the last day of the year. Maybe the average over the year was higher than the year before. Okay? That's one explanation. That's why I said, let's assume the interest rate was the same. But might be also that the interest rate have changed. And that's a whole discussion we're going to have. Great. Any more questions? That's a heavy duty session today, I think, isn't it? Hello?
Yeah,
Yes.
Yeah.
a lot
It
of
is
accounting.
heavy. Frankly, it's heavy. I try to do it as less painful as possible. This last one is extremely important for valuation. Let me make a couple comments on that, and then I will dedicate the last few minutes we have to what we're heading to. Why is it so important to get a good understanding of this little box in the bottom? Because this is really the cash flow of investors. I can look at the company as a black box, and I ask myself, well, or I should really say the investors ask themselves, how much money I'm putting every year, how much money I'm getting out of the company. Do a discounted cash flow, that should be the value of the company. This is really the cash I'm getting from the company this year. If I know next year, a year after, a year after, a year after, if I knew all the future of this little box, I can do a discounted cash flow, and that's what should be the value of the company. That's why I'm spending a whole session on this session. By the way, doesn't matter which accounting rules you use, cash flow is cash flow. That's the beauty of the cash flow. Accountant cannot manipulate this number. This number is like gold. Nobody can manipulate it. Okay? So, and that's why that number is so important. They might manipulate the depreciation, but we already reversed that, if you noticed. We added back. When we did the statement of cash flow, we added back the 40. We added the 40 right here too. So depreciation has no effect on the cash flow. So accountant, doesn't matter what they do, they cannot manipulate this number. And that's a beautiful number. And that really should be our guide for next sessions as well. And if we know the future and we know what this number is in the future, we can do the discounted cash flow of it, and that should be the value of the whole company. In the sense, it should be the total value of debt holders and equity holders together. We'll talk about it more in the following session. I have another 3-4 minutes. Let me just say what we're heading to and what I'm asking. I think I already said what I'm asking you. Homework, please go over there. Just go over chapter 1, read the question, join the blog, and plus you make a discussion. And I really expect everyone to put his own contribution to that one. Second, please do go over those questions. Take a test. Those are really meant specially for you. Good review for you. You get a response right away. And next time, we're going to dive a little bit on what intrinsic valuation is. Again, there is a little bit of accounting stuff as well, but I try to minimize the pain as much as possible. This is Excel that I made. Eventually, all those going to be a simulation. It's going to be interactive right on this page. So we'll get rid of those Excel. Unfortunately, my time is so limited and I focus on the most important things. It's the company valuation simulation. We'll try to understand this one eventually. Try to do, try to review it, even if you don't really understand it fully. Try to go over that, okay? And I put here the Excels. You can play with it. So you'll be ready for next session. And this one you should really know from your finance class. So let's put it in this way. Next session, we're moving from accounting to the finance element, and then we're going to dive, how do we do this exercise to get to the value of the equity owners, and eventually to how much is the intrinsic value to a share, per share. Any questions, guys?
Just in terms of the homework, is there a difference between your homework assignment and take a test, that other button?
No, I tell you what, everything I do, it's for you. Meaning, it's a really unconventional answer. The assignments, it's a group assignment, and the reason I'm putting them, it's splitting your paper over the semester. So every time you will do something, you progress in your paper. By the end of the semester, I am expecting your team, you will finish the paper, okay? The homework is really individual homework. Again, will help you to prepare for the exam. In addition to the homework, I take a test, it's also for you, okay? I'm not gonna kill you, I'm not going to downgrade you if you don't do it. But I think you will be much better if you really do them. It will take you much less time, help you to summarize what you really should know from the chapter you read. And it's so easy. You just read the question and you immediately get a response if you're right or wrong, okay? So that's the reason I built those ones. I hope I'm answering your question.
Yeah, thanks.
Yeah, I just over the years, I noticed I'm trying to do my best to give you as many tools. It's not really a simple topic, frankly. And I try to put as more component that will assist you to learn and be prepared for the exam, not 2 days before the exam. So over the whole semester, you'll get a really clear picture.
You said that assignment is for groups and homework are for single.
Exactly. Again, this one is mandatory. We'll have to submit a paper by the end of the semester as a group. Homework and take a test, it's my recommendation what you should do, okay? And you can really consult your friend. If you have a hard time with homework, that's why I put some of the stuff in the blog, okay? So you talk. There's no really copying. I allow you to copy. By copying, you learn, okay?
So
And
the assignment.
I'm putting it in the blog for discussion, a lot of them.
So the assignments made in groups will help us towards the final paper, or the assignment is just the final paper?
The assignment is just final paper. The assignment I'm giving on the basis of 2 or 3 weeks, additional assignment. We progress in the material, and then I will ask you to put it in your paper. The next assignment going to ask you, now that you chose a group and you chose a company, the first assignment it's usually that I give is to write a page between 1 to 3 pages on the company, SWOT analysis, strategy of the company, portrait, whatever you learn in other courses to understand what this company is, what is the industry they are working in. That you do in a group. And then that's going to be your first chapter in your final paper. Later on, I will ask you to do calculation of the WACC, and I will lead you. What is the cost of debt? What is the cost of equity? And that will be an assignment as well.
Can we pick whatever company we want?
Yes. In fact, I just try to make sure you don't hit on a company which will be too hard for you. So I recommended the top 100 companies in the US, but if you rather to do on another company, you are more than welcome to do. I just strongly recommend, before you do that, let me go back to the simulation. And that's why I did it still. Do you have another company in mind that I didn't put on the list? Throw one. Let's say, this is one of my favorite companies, by the way. 3M, I don't know, it might be in the list. But before you do that, just try to put the data on it right here. And you're gonna do 2019. Click on the data, I did it especially for you. See, this company, it's a good one to do on. You have all the data. You're missing share price, just look it up for 2019, look it up and type it in, okay? You can go into Yahoo Finance or whatever it is, type the number there. All the rest, I see most of the numbers are there. That one you don't really need for the valuation. This one are fine, interest expense. Yeah, they are missing 3 numbers here. You will need to fill up those numbers. Otherwise you won't get the right. And that's about it. All the rest you have.
If we pick a company that doesn't have a share price like this one, which month should we?
I would strongly, if you don't have the numbers, then you will have to go to the annual report and type the numbers here. And then you will have the whole valuation calculated for you. But if you pick up, let's say, let me take another company, which I think I showed it last time. Let's say Amazon, okay? Let's go into Amazon. So now Amazon is a huge company. Most likely all the numbers will be there. Yeah, here we go. You won't have to do any hard work on finding data, which is not a simple exercise, by the way. Okay, let's go into Amazon. See, Amazon, I have all the data. I'm not missing anything of 2019. So this one will be clean. Let's go to calculation. Amazon, the only things we will learn, we'll get to this part, we'll learn how to do cost of equity. You should use which industry they are operating. So Amazon, it's not just retail or whatever, they really are into computer services. The argument is it's services or software. And here I made even a special one. You can click here. They're also in retail, but online retail. So you try to find, I don't know if you can see it here. Anybody see retail, internet, something like that? Retail, internet, here we go. Now, you can really look at the financial statement and see, let's say the computer, I'm just making it up, they're making 10 million, I don't know. They're making much more than 10 million, yeah? Let's make 10 million. On the other hand, on the retail, they are making only, I don't know, 100,000, okay? It will do a weighted average automatically for both of them, and it will use those one in the valuation. And that's pretty neat, okay? So if you do for Amazon, and then you will try to explain what the difference between those two, that's what we'll learn in the following session. But having this simulation, really, it's a blessing. I mean, I was waiting for this stage. I just introduced it last semester, and I got a lot of very good feedback, and I'm expanding it. Over time, I will add even another folder here showing all the companies and what's the difference between the valuation and how much they are being traded for. But for your assignment, try to pick up a company. You don't have to work too hard. I know that you are too busy with so many other classes. And I really would like you to understand and spend your time not on a dirty work, but really spend on the theory, how it should be done, and not on data entry. Okay? Cool, guys. Everybody
I have a
happy?
question.
Sure, go ahead.
Is the assignment right now still just to pick a company, or are we moving on to the next stage?
Now move to the next stage after you finish the first assignment. Where is it? For now, I didn't post the next assignment. I usually see the progress of the class. Sometimes some session takes longer than others. So for now, we kind of really finished this part. Just have to do those two, and you already did that one. Next time I will put, you will have assignment. I don't even remember. I think I already posted. Yeah, you will do the SWOT analysis. I already posted it. Okay? Now, there's another feature which is really cool. You can use your friend, you can upload text or image, video or file. Let's say you want to upload a file, you can upload a file, and only your team will see it, okay? So anyone who will upload a file, you can see it right here. You can upload text, it's just right, and only your team will read it. Then you can just delete. This is for you. I'm not interfering at all. So it just makes your life easier. Okay? You can upload and you give it a title and save the content, and then you have another file. Someone else in your team wants to see what you did, can read it, you can collaborate. It's meant for collaboration, easy collaboration as a team. Let me know if you like it. If you think I should change it, please let me know. I'll be more than happy.
Thank you.
Okay, everybody happy?
Yeah, thank you very
Very
much.
happy.
Yeah, great. Thank you very much, guys. Please feel free. I sent an email. I want to repeat what I started today. Very important for me that you don't get stuck on any technical issues. And I don't want to waste the time of the class on technical issues. So if you do, anyone has a problem of logging in, whatever reason technical, let your class representative let me know, and I will make a special session to answer technical questions beside the class time. Okay? Thank you very much. Have a good one.
Bye-bye.
Thank you.
Thank you.
You.
Thank you very much.
Thank you.